Do you know the difference between an asset and a liability? So to begin to know the difference between an asset and a liability, first and foremost, we have to get into what an actual asset is and what it means to have an asset. Because you might have grown up with the notion that an asset is something, as long as you've paid for it, or as long as you've got it in the home, or as long as it's a physical asset, like an actual product you can hold, like your phone for instance, or whatever you might have, your golf clubs, your house, your car. Normally, you're under the assumption that that's an asset, that your car is an asset, that your house is an asset, that your phone is an asset, that your golf clubs in the garage are an asset, and because they're paid off, because they've got no debt against them, that's what an asset is. What would you do if I told you might just be wrong, and not wrong in a bad way? Let me just show you to think differently on how you should look at an asset. First and foremost, look at the type of assets you can own, okay? You can own assets that effectively don't do anything, they lay dormant, they don't have any value to your house. So in order to have an asset, what you've got to think about, and you've got to keep open-minded here, because it's going to be hard for some of you to swallow, but think about that item that you have, okay? You have your own home that you live in. You have your vehicle that you drive. You have your mobile phone that you use on a daily basis. You have your golf clubs in the garage. Question, do you think they are assets? Answer, it's no, they aren't assets. Yes, they hold some value, but until you sell them, they owe nothing to you, okay? So until you sell that particular item, your home, your phone, your car, then really it's not an asset. Now, let's look at the type of asset you can own, okay? And let's work out if it is an asset or it isn't an asset. First and foremost, let's go straight to the jugular. Your house. Is your home an asset? The one that you live in with you and your family, okay? Regardless or not if it's got a mortgage, is your house an asset, the one that you live in? The answer is no. Now I know you're probably thinking, Simon, what are you talking about? Why are you talking so much rubbish? I've lived in this house, I bought it at £100,000, I've been in it 10 years and it's gone up 8% every year, whatever it's gone up by. And yeah, you'd be right, yeah, it's a great value, it's a great appreciation asset, you know, it's gone up in value. But until you sell that property, it's done nothing for you in a monetary way. The only way that house then becomes an asset is, for one, you sell it. So you bought it at 100,000, you sell it for 150, you've made 50 grand, your asset's paid off. You've started to get dividends from that asset. Perfect, it's now an asset. But while you're living in it, technically your home can be classed as a liability because you've got council tax, you've got bills, you've got all your living expenses, maintenance costs. So really that home is more of a liability to you because it's costing you on a monthly basis, all right? Now let's flip it. If you didn't live in this property, i.e. you rented the property out, yes, you used to live in it, but now you've gone on holiday for 2 years, or you know, you've moved country, or you've just moved to another property. That same home you lived in, if you start renting it out, or again, you sold it for a profit, but let's say you're renting it out, that property now starts to become an asset because you start making money on that building, you start making money on that asset, so it becomes an asset. It's now worth something to you. Every single month you're gaining £500 in rent, your council tax, utilities and everything else the tenant's paying for. So realistically, as long as this mortgage is covered, or you've got, you know, so many very nominal outgoings, it's an asset to the point where if you have an outgoing of a mortgage for £800 and everything else and the rent is 801, it's an asset because you're making £1 every month. Yes, crazy figures and probably not realistic. My point being is, until that asset starts to make money, it's not an asset, okay? Example number 2. A lot of people we hear all the time have golf clubs, all right? Golf clubs, a car that's paid off on finance, a certain watch, all right? A mobile phone, for instance, okay? You could class them as assets, but again, you would be wrong in a way as if they're just your personal items that you use on a day-to-day basis and don't do anything with them. They're not really an asset. So for instance, how could you then think, well, yes, Simon, how can I turn golf clubs into an asset? Well, number 1, you could go on these comparison sites where they actually lend their clubs out for rental. Okay, you could take them to the golf club, you could let people use them and rent them and pay them on a match by match basis. Weird example, I know, but just stick with me. Number 2, you could sell your golf clubs. So you might have bought them at 100. If you sell them for 200, they've become an asset. Number 3, your car, if you wanted to, if you're not using it that often, you could rent it out on weekends. You could, rent it out on the weeks that you're on holiday. Then it becomes an asset. Your mobile phone, you could sell it for a profit, you could let somebody use it for £10 a go. They're very unrealistic terms, and the same for your watch. You could sell it at a profit, or you could rent it out for people going to events, whatever. Again, the point I'm trying to make is unless you are making money on this property, and when I say property, I mean the things you own, the mobile phone, the watch, the golf clubs, whatever it might be. Unless you're making money on these assets, they're not assets at all. They're just products of what you own, and there's a debt towards them, because the longer you hold on to that mobile phone, the more it's going to depreciate. The same for the vehicle, unless it's obviously a classic, and the same for the watch, obviously, unless it's obviously a watch that's going to go up in value. Most do. But until you sell that watch, until you sell that phone, until you sell that car, and unless you're making money on it, as in you bought the car at 10,000, you're selling it for 15,000, it's not an asset. And it's so important to understand the difference between the two, because you might have one asset here which, yes, it stands to be a value of £10,000, but it's only ever going to stand to be that value unless you sell it. And if you plan on keeping it, it's not really an asset. All right, it's more of a liability, because there's space for you to keep it in the house. You might have maintenance costs on that item and everything else. On the other hand, if you have that item and you rent it out to somebody to use, i.e. your car, you rent it out on weekends, your watch, you sell it for a profit, your house, you rent it out every month, whatever the case might be, until you start proactively looking to earn from that piece of material, product, item, whatever you own, it is not an asset. And it's so important to understand that. I fell short of this a lot, a while back, even to the point where you've got savings in the bank. Unless them savings in the bank are making more than the inflation rate currently, and the inflation rate's been a bit of a bad time, especially in the UK. But if you've got money in the bank sat there, if anything, you're losing money on it, and that's not an asset either. So you've got to put these things to work. We've talked about assets and the difference between a standalone asset and something that's going to make you money on a continuous basis. Let's talk about liabilities. So what do we mean as a liability? Number one, a liability is something where it's going to cost you. Okay, it is a liability, it is a debt, it is something that you are liable for. 9 times out of 10, the standard liability looks like your mortgage payment, the loan on a vehicle, finance on a sofa, on your golf club, your watch, whatever it is. Again, it's something that's going to cost you on a continuous basis. Now, what's the difference between a good liability and a bad liability? Because there is two differences. There's a good debt and there's a bad debt. Good debt is where you can effectively leverage and make money from. Now, let me give you an example, okay? And you've probably heard this example a million times, all right? Don't worry, I'm not trying to sell you a fucking course. No chance. But just to give you an example for this reason, you have a property that's worth £100,000. You have no mortgage on this property, okay? But what you think to yourself is, well, I've got a property here worth £100,000. I have no debt against that property. I wonder if I can borrow some money, put it against the property, and we create a mortgage. Now, this is where the good and the bad debts, you've got to be careful here. Let's say you borrow £25,000 from the bank, so you've got a £25,000 mortgage on your property, which is paid off. If you did this and used that £25,000 to go on a nice holiday, buy the kids some presents, to buy yourself a new camera, watch, whatever, then that is becoming bad debt. All right, that's becoming consumer debt. You've used that money to purchase things for yourself in which are not going to make you money. On the flip side, if you use that money, that £25,000, to use as a deposit towards a down payment on a buy-to-let property, as in you maybe buy a house that you want to then rent out, or for instance you buy a car that you plan on renting out, or you buy a watch that you're planning on selling once the value's gone up. Unless you're doing that with that liability, with that debt, with that £25,000, it's a bad debt. If you do that and you use that £25,000 to buy stuff with the aims to make money on it, it becomes good debt. So what you tend to find is a lot of people, they'll have a house that's worth £100,000, £200,000, and their mortgage might be only £50,000 or £100,000. And what that means is they've still got a little bit of borrowing power. So because they've not gone to the maximum amount of borrowing on that home, what you'll find a lot of people doing is, and you'll hear this from all the gurus online, that they'll borrow more money against their own property, so they're increasing their mortgage. They will then use that money to use as a deposit on their next purchase of a property, but this time the property they're buying is intended to be rented out. Let's say, for instance, they pull out £25,000, so they've added 25 grand to their current mortgage. Their monthly payments have gone up or whatever. Borrow 25 grand extra on their mortgage. They've then used it on another property, so they're buying another house, they've put £25,000 down as a deposit, they've then taken out the rest of the house on another mortgage, so now you've got your mortgage has increased, they've also got a new mortgage, but their plan will be to rent that new house they've just purchased with that new additional funds earn enough to pay the new mortgage as well as the additional mortgage, plus normally a bit more as well, and they're going to get a surplus income. So they've just turned £25,000 debt, so they've come out of nowhere, they've not used their own savings, they've pulled it off their mortgage, they've used it to put a deposit down on a new property, they've got a new mortgage amount, and then they're going to rent that property out, which is going to cover the new mortgage, cover their additional mortgage on their home, and hopefully be left with some profit. That is good debt. They're making money work for them, and they're making it work for them in a way where it's enough to pay back the loan payments or whatever agreement you've created, the interest, whatever it is, it's enough to pay that back. And that's what we mean by good debt and bad debt. Again, just to summarize, a good debt is something where you can use borrowed money to make you money. Good debt. Bad debt, you borrow money to spend aimlessly. You spend it on crap you don't probably need or stuff that you don't particularly want, but makes you feel good for 20 minutes. All right, I get it. Listen, got a camera that I rarely use. I've got a nice phone. I've got a watch that I rarely wear. We're all part of it. All right, we are part of it. And because we call them assets, we think, well, one day if I sell it, it's all good. Yes, I get where you're coming from, but try to understand the difference. To summarize it all, a good asset is something you can make money on continuously and now, not in the future now. A bad asset is something you purchase and leave to sort of gather the cobwebs, all right? Or something that you purchase and it's going to cost you maintenance on every single month, okay? I hope it helped. If it did, make sure to like and subscribe. We'll come back with more videos on this. Cheers.